Hi there. Welcome to StartupSteroid. Today, I'm really excited to interview Vijay Kotrappa, who is a very good friend and a fantastic angel investor that I'm really excited to learn from. He is also the board member of the TiE 2020 fund, so tremendous responsibility there. And he's also the trustee for TiE Global. So again, he's been around for a very long time, has tons of experience, and today I'm really interested in exploring his story and learning from all of his experiences. So it should be a fantastic interview. But before we get started, a little bit of housekeeping. First, if you're an angel investor or are looking to become an investor, please send us an email so we can get you added to our network. We can give you the right resources you would need to get started. My email address is on the screen right now. It'll be again on the screen at the end of the interview, and it's also in the description. So you can just click and send your contact information our way so we can get you added to our system. If you're an entrepreneur and are looking to raise funding for your startup, get in touch with us. You can get in touch with us by going to our going to our website, which is startupsteroid.com. And click on the founder button and fill in the form. So again, we can get you added to our platform and start sharing your information with our investors. Having said all that, let's get into the interview. Here's Vijay Kotrappa. So Vijay, thank you so much for coming on today and doing this interview for our entrepreneurial community and so that other angels can learn from you. There are so many little things that, I know about you, but I want to get so much more color on. So let's start with your background and sort of your entrepreneurial journey. Uh, where do you think that entrepreneurial spirit came from, and how do you think it sort of manifested for you?
Um, I have never really worked for a large company ever. So it was pretty much right after grad school, worked for a company for a few years. And then after that, about 3 years. And then right after that, got into doing stuff on my own. And initially, it started more as a consulting gig at Hughes, which is Boeing now.
Mm.
And that's where I met my first partner. We were doing a project using a product for Hughes, and then we decided to start a venture based on that product. And so that's what really launched our company. And this was a while ago. This was back in 93, 94. So about 20, 30 years ago.
Right.
That's when we started our journey into a startup mode. And even before that, we were doing small things on the side, like selling computers and stuff like that, assembling. And those are the days when a 20 meg hard drive was a big deal. It
Yep.
was a challenge, and we would actually go and set up a computer at somebody's, like a bookkeeper's office, with 2 megs of RAM. That was a high-end computer. So that's what kind of led to the startup environment, and it had to do with my roommates as well. They were into the startup mode. They also wanted to do something, although we didn't start the business together. But each of us was kind of we're doing different things,
That's
and that's
fantastic.
my first company.
Yeah, and it's usually that entrepreneurial spirit from people around you that sort of gives you more motivation, right?
Yeah, yeah, true.
uh, so this is back in the early '90s. You're already into computers and IT. I'm not 100% sure, but I guess that was your training, right?
Yeah, that first venture, which really was the one that launched things for me, was that we started as a consulting company, and then in about 97, 98, that's when the whole internet and things was
Yeah.
really taking off. And so we shifted more to offering internet services. So developing
Nice.
e-commerce kind of solutions. So to be a small e-commerce site for an electronics parts company or stuff like that. And so we were doing e-commerce solutions. And then the whole dot-com industry just took off at that time.
Right.
And we started helping launch the dot-com divisions of large brick and mortar companies.
Oh, okay.
So, a company like Big Strouds or something, we would do Strouds.com. If there was a large real estate company, we created eProperty.com and eNutrition.com. So these companies were basically offshoots of the large brick and mortar companies. And they had fun because they were the large brick and mortar companies. But they wanted to have separate ventures focusing on the web. And so we would help them launch those businesses, would help write their business plan, and then we'd take a significant ownership in that as well in lieu of our service fee. So we'd take a small service fee, and then we would take typically about 10-20% equity in these companies.
Right.
That's when our valuation also became very high. And we got funded from a large private equity firm back in 99, 2000 time at that very high valuation. And they were saying, and there was a large PE firm, so they had about 150 large investments in retail and manufacturing. And they basically said, hey, do these ventures for us. Right. You don't need to go out, you don't need to charge any fee at all. So that's how we got funded, and that was give a little opportunity for us for our three of our partners to exit a little bit.
Fantastic. So this is right before .com. What happened as you hit the .com bubble or that burst in 2001?
Well, they invested in us, I think late 99, early 2000. And the whole .com thing, the bubble broke in a year or two after that.
Right.
So all of our ventures obviously became worthless. And these were all companies that were at one point worth $50, $100 million each came to zero. And the brick and mortar companies, they were fine with it because they had their other business anyway.
Right.
So the company valuation obviously went down significantly. And the PE firm also said, this is not our core focus anymore. So we actually ended up buying them back out.
Okay.
At a much lower value, obviously.
Right.
And then three of us partners, we continued there for another 2-3 years, and then three of us left, and the company still is running right now with a new CEO, and he actually bought the company from us, and we still have a small ownership in the company, but it's still running, still doing well. It
Fantastic.
Came down from 200 people down to 50, and revenue. But now they're doing financially well. We never did financially well before because we weren't taking fees for our services.
Right. Very interesting. So you exited there, and obviously you had the initial private equity investment, so that gave you a comfortable cushion to exit with.
Right.
So what did you do after?
So right after that, I got into more of on the nonprofit side, kind of the social. We were helping public schools raise funds, basically. We had created a program called the America Schools Program, which was creating marketing programs for these public schools. So we're trying to replicate the Olympics model where we would create a symbol across the country and the school system would license that symbol, and then we would then sell that symbol to companies. So for example, Ford could be the official car of the America Schools. And most of that money would go back to the schools. So we had relationships with 17 of the largest school states in the country, their school districts. And we covered about 65% of all the schools in the country. The challenge was more of getting down from the state level to the district level to the school level. Right. We even got down to the district level, but at the school level, the bureaucracy and everything just killed the program.
Right.
They just wouldn't, they felt that they were selling out to these companies. And said that, and they wouldn't adopt it because of internal bureaucracy. And so we ended up creating smaller programs at the school level, but not on the grand scheme of things that we were envisioning at the country level.
Wow. Okay. Yeah, that education space is so sort of fragmented, right? With every school district, every town has its own sort of bureaucracy. It's hard to.
Right, and the fact was that they were doing a lot of those what they call selling themselves to these companies anyway. For example, you'd have a basketball court in the gym, and they would
Right.
have the scoreboard, and they'd have a name of a company up there. And that's pretty much what we were doing. We were
Right.
creating, let's say, a bottled water company would going to be the official bottled water of California schools.
Right.
But they felt that that was hawking the school system.
I guess it all depends on the perspective, but
Yeah.
that's really funny that they're fine having the logo up there, but not not
Right. And
being
it also
branded
comes
out.
down to whose idea it was. See,
Mm,
they're putting that billboard or sign on the school gym. That's the school's idea.
right.
These were the ideas of the states and the school districts. So the schools was like, hey, it's not our idea. It must be something they're trying to push down our throat. So we're not going
Right.
to do it.
Right.
That became a challenge.
Wow. So how long did that last? That project?
I did that for almost about 8 or 10 years.
Oh wow.
Never
Okay.
did financially well on that one. It was more of it was a lot of fun.
Right.
And we were actually adding a lot of value to schools, the PTOs, the state school boards. We were created an environmental youth program, all kinds of fun things that we were doing. And it was giving some cash to the schools. So we had a recycling program for printer cartridges. So the kids would bring in cartridges and they would get like $1, $2 for each cartridge.
Nice. Okay.
It wasn't much money, but like $300-400 for a school. But they would then be able to fund their basketball team.
Right. Or get new uniforms.
Yeah, exactly.
Right.
But it was also helping them understand the value of these kinds of efforts, whether recycling or fashion or stuff like that.
Right. Right. Right.
So after
And,
that, I got back into tech again after that in a couple of
okay.
ventures.
So let's talk about that. What was the next step like, and your return to tech?
Yeah, I mean, tech was always my background. I mean, even when I was doing the America Schools program, tech was kind of in the background all the time.
Hmm.
But tech is really the core of that's my background.
Right.
And so I got it, and more on the healthcare side. So I got involved in a couple of businesses focusing on dental and medical industry, focusing on reputation management and sort of marketing at the practice level for dentists. So this was a little bit before some of the large companies that exist right now are in that space. So we were trying to be like the Yelps or the reputation companies for these dental practices.
Mm. Okay. And
I think we were a little early for that, and then so it sort of worked. I mean, that company grew to a certain point, and at that point, it was going to take a lot more effort and money to scale. What we realized was it was more of a retail, almost like a B2C kind of play. And even though it's still B2B in the sense we were selling to dentists and doctors,
right.
but the effort it was going to take to adopt many dentists or many doctors, you just needed a local retail sales staff. And so that became hard to scale. So for example, when we started on the medical side, we would get doctors signing up, we'd have 2-3 doctors signing up every day to our system, but we wouldn't have a critical mass of doctors in any one city. So if somebody was looking for, say a pediatrician, we might have had 2 people in your city. And that's not enough critical volume for you to decide on, hey, I want to pick the right pediatrician.
Right.
So once there wasn't enough patient interaction, the pediatricians also kind of, this isn't working for us. So to make that work, it basically would have needed feet on the street, going to each of the pediatrician's office and saturating a local geography.
Right.
And that basically would have taken a lot of money.
Right. Right. And a long time, right? To get to scale like that.
We could have done it in one city and added value there. But the
Right.
scale, again, needed a significant amount of money. It's like the Yellow Page system or the Yelps. You do need a local staff calling on these doctors and dentists.
Right.
And again, you had to actually create a market for that. Many of these healthcare providers didn't believe they needed it. It's kind of the aspirin and vitamin situation. It's nice to have, but wasn't critical for their business.
Right. Very interesting. So then you got into, as you're going through this process, you got into angel investing and supporting other entrepreneurs. So let's talk about that transition, because it sounds like you're already moving in that direction. What sort
Right.
of
Even when I
got that
was
started for
back
you?
when I was doing the public school project or the
Yeah.
others, I knew quite a few people who were in the software industry still, and I, in looking at what they were doing specifically, that's kind of what motivated me to either invest in their effort or help them in some way.
Hmm.
So that essentially was my route to angel investing, is to looking at companies, looking at people that I liked working with and I saw value in. And I was hoping that that would materialize into some sort of a financial return as well. So it was
Okay.
initially a target of, this is a project that I was a customer essentially
Right.
to that product, or
Right.
I found that fascinating.
Fantastic. So it was really supporting the business that you were
Yeah,
patronizing and you were sort of, you
right.
liked.
Yeah,
Very, very interesting.
like
Okay.
the America Schools program that, I mean, I should have probably been an angel investor rather than run the company.
Right, right. Yeah, I mean, a lot of, especially now, we're both part of the TiE group together. And when we look at certain businesses, it's easy to see how much work it's going to take,
Right.
having gone through that experience, right?
Well, it's actually, I mean, the TiE, the angel and the angel fund has been phenomenally useful because
Mm,
it's very different from an angel investor perspective where you're investing on your own versus when you're investing along with someone or with somebody else's money.
right.
The amount of diligence that you go through when you have someone else along with you or somebody else's money is significantly higher because
Hmm.
you kind of have that fiduciary responsibility
Yeah.
versus if it was your own money, suppose you invested, just say 25,000 and you lose it, it's your choice. I mean, you made that decision and you lost it. Now you feel bad, but uh, as a result, the due diligence that you go through is not that much. And when you try to invest on your own, and as a result, you probably end up with more failures than success because it's more of an emotional investment at that point.
Right.
You like the person or you like the business, but you haven't gone deeper to find out if it really is a good investment.
Right.
Angel investing is one of those things where you're not going to be able to invest in hundreds of companies. You're going to invest in 3 or 5, maybe 10 companies. And then with 10 companies to play the odds is tough. I mean, very likely all 10 will fail.
Right.
If you're lucky, maybe two will work out. But if you have a group of investors like the TiE Angel Fund or you have an angel system, then it's just not yourself. You have someone else kind of working with you on it, whether it's due diligence or giving you other perspectives. I mean, so many of the projects that both of us have worked on, when we hear the first pitch, we're super excited about it,
Yep.
right? And then one person will say something negative, and then like, oh, okay, well, maybe that makes sense, right?
Right.
Or we dig a little deeper and we find some other flaws, or someone's had a different perspective on why it wouldn't work,
Right.
and then we move on to the next project. I mean, it's very possible that some of the things that we decided not to invest in will become successful, but that's just we missed out on it. But you can't just put a little bit into everything. You have to make your choices.
Exactly. I think that you're absolutely right in that angel funds, um, what that allows you to do is get different specialties on
Mhm.
one project, right? So for example, your background obviously is in IT. When we work on a project together, I'm looking at it more from the financial perspective.
Right,
You might have someone else who's looking at the go-to-market strategy. So
right.
now all three of us are analyzing one company from different
Mhm.
perspectives. And you know, everything might be great, but one piece is missing. So their
Right,
go-to-market strategy is
and
missing. And
and
then
also what happens is most of us can kind of serve all those three roles.
mhm,
For example, I mean, you could understand the technology as well. I could understand the finances as well.
right,
But if we're just doing it on our own, we get enamored by one little aspect of the company, and we
yes,
tend to ignore the others as being, oh, they'll figure it out. And
absolutely.
that's what kind of skews the decision when you're trying to do things on your own. And when you
Right.
do it as a group, you get that additional perspective, and then you decide, and you can still invest on your own. That's perfectly okay.
Right.
And the difference between angel investing, so there's angel investing when you do it just as an individual, and
Right.
that's a crapshoot. I mean, you like the person, you like the project, and you just invest. So that's the reason.
Right.
When you do it at the next level, you do it in a fund or a group of people with kind of an angel group, and that gives us a little more sophistication. But still, you're investing it's still an early investment, early stage. You're not getting the professional investment perspective that you might get from a regular startup fund or a separate fund where they have a staff of people and it's a larger fund. For example, suppose there's a $50 million fund working on startups. They have the resources to do much more due diligence.
Right.
And they're not investing 50,000, 100,000. They're investing $1 million, $2 million.
Right.
And they have much more leverage in the company and they have much more insight into the company. So that's kind of the next level. So your returns may not be 2x, 3x. It might just be 20, 30% rate of return per year. But that's what you're giving up for a little more security. So it's a little more lower reward, low risk, low reward at the fund level.
Right.
And then you can do your real estate, which is even lower risk, lower. So I think you have to really establish kind of your own portfolio of your risk reward spectrum. And then the angel investing really comes down to that high risk, high reward, but there's a little more of a personal interest in it. And that's why you do it.
Absolutely.
You might like the company, you might like to stay involved with the business. And that's what you like. If you're investing in a large fund or something, you have no idea what's going on. If it does well, you're happy. If it doesn't, there's nothing you could have done about it anyway.
Right. No, I think just sticking with the lower end of the spectrum, so I guess higher risk return profile for investments. I think the distinction between just individually angel investing and investing with a fund where you are an active member, where you're participating, or at least the players who are participating, and you can stay in touch with it with monthly, quarterly updates. With that, there are so many different dynamics. I mean, just talking specifically about TiE, where we're both members, and we've both worked on deals. When you are individually investing, if you're writing those $10,000 to $25,000 checks, you can only invest in so many companies.
Right, exactly.
With a fund, even if it's $1 million or $2 million now, you're a small fraction of that fund, but you're still spreading out over so many more companies. So you're still reducing your risk tremendously.
Sure, the diversification is huge. Suppose I had $50,000 to invest, I might be able to invest in 10 companies now. Versus if I was just doing it on my own, it might be 1 or 2 companies.
Right, exactly.
And even then, it would be such a small investment that I really wouldn't have leverage at the company. If I ask for an update, I probably won't get it.
Right.
But now if the fund asks for an update, they will get it.
Right. Exactly. And fun, you're absolutely right that as you move up those dollar amounts, you can become an advisor, you can have a board seat in the company. You might even have other branches into the company where you're talking to the CFOs or the marketing person. So you can get a lot more insight as you move up that scale.
And it also it's kind of the best of both worlds. So for example, now in the TiE fund we have, if there's a company that suppose we decide to invest as a group, and I'm really excited about the company, I mean, I could be nominated as a person to kind of be the point of contact. So I could essentially be involved with the founders, be involved with the company, help its growth. So all the things that I would have done if I were just an individual angel investor, I could do that as part of the fund now.
Right. Now you're much more hands-on. Yeah. And now since there is a fund behind you, you have that much clout going into the company also.
Exactly. Yeah. Right. And in some ways an excuse too. If there's something you don't want to do, say, hey, my fund people said I can't do that.
Right. That's always a good excuse to use. That my board won't allow me to do that.
Exactly.
So let's talk about how you actually find these investments, because a lot of new investors, new angels, they sort of struggle with finding good opportunities. And when they find one entrepreneur that they like, they feel like they have to go with him and give him a check, because they really can't see all of the other opportunities that are out there. How do you get your deal flow? So obviously TiE, is
Right.
helpful in that. But let's talk about your network and how you sort of source deal. And by the way, TiE this year has a fund, but until now, you guys were investing individually. So
Right.
let's talk about a little bit about how you sort of use that network and how you
So
source those deals.
the TiE network itself has been a large source of kind of introduction to these companies, whether it's in the SoCal network or the global network.
Yep.
Just by getting to know these companies that might come to, say, the TiE conferences that happen in Silicon Valley every year. So you have the top 50 companies that get picked to come and pitch. So you have the Fast 50. Those companies are usually, they're decent targets to get further into from an investment perspective. And they're all at that early level, kind of a pre-seed 5 million valuation, kind of 3 to 5 million valuation. So that's an interesting group of companies. And they've essentially competed among, they have several hundred applicants, and they picked 50 to come and pitch there. And you have, there's plenty of diversity in terms of the industry they're in. Some might be in AI, some might be in retail. So you can actually look at a company or look at a few companies in a specific industry that you're interested in. If there's something on import-export that I know nothing about or I'm not interested, I can pass on it versus something in, say, healthcare tech that I like, that I know a little bit more about. Or I decide that's at least I can add some value or make a more intelligent decision on. So the TiE network is an extremely good network for that, for me personally. Other than that, it's more of our friends are involved with other networks. If they decide there's a company that they're planning to invest in or they see, they'll let me know. And then it's up to me to decide if I want to participate or not. But right now, I'm focusing most of my angel investing through the fund itself because, like I said, I do get the best of both. I can help the companies as well as get the diversification here.
Right. Since both of us are members of TiE, this almost is becoming a sort of an ad for TiE, which is a great organization. So nothing wrong with that.
Right.
So let's go back and since you've been investing in so long, let's talk about your portfolio a little bit because I've sort of asked you a couple of questions here and there, but I really want to understand what kind of companies you have invested in the past.
So the 2 or 3 companies that I invested in early on when I wouldn't call myself, the term angel investing, I guess, wasn't even around at that time.
Right.
It was more after my guidance days when we had exited the business and stuff. So I invested in, including this America Schools program. They were struggling, so I invested some money into that and took a leadership role in the business as well. So that was more of out of passion of the business for the individuals. And those, I think it was more because it was an emotional, and again, lack of diversification, right? You're investing in 2 or 3 companies and the odds are they're not going to work.
Right.
So out of those 2 or 3 companies, none of them actually made it. The public school company went totally bust. The other one company, it's still struggling. It's still in play, but I don't think my equity is worth much in that company. And a couple of other companies that I invested since then, and again, partially more because I got a little more educated into the angel investing. I saw more deals and part of the TiE network as well. Those have at least increased in value on paper. So they've gone 2x, 4x, at least on paper. They haven't monetarily returned, haven't got an exit from those yet. But at least that's a feel-good thing that they've gone up 4 times in value, at least 4 to 6 times.
Or at least they're still around.
They're doing well.
Right.
And they're raising additional funds at a higher value, so you know your equity is worth more.
That's great.
When that translates into an exit, that's a different story.
Right.
But that's a risk you take with these early stage companies. You're not investing at a Series B or an IPO level company.
Right. I think that's another very important lesson that a lot of angels can learn. That is, when you invest in these, that, most people invest in the stock market, and stock
Hmm.
market, you can invest on a Monday and sell that investment on a Wednesday, and maybe you made a little bit of money, maybe
Right.
you didn't. So your commitment isn't really that long. You might
Right.
choose to stay in a investment for 6 months, a year, or 5 years, whatever,
Hmm.
but you have the option to pull out whenever you
Right.
want. In these kinds of investments, that's not the case. These are not
Right.
liquid investments. So once
Right.
you're in, you're married, and now it's a
Hmm.
5, 7, 10 year, maybe more commitment with that company, with that
And you have
entrepreneur.
no control.
And you have right.
It's in some other instances where the liquidity is low, there's a possibility of doing something about it.
Right.
Maybe you can exit at a lower value or something. Here, you're pretty much, you invested and now just wait.
You're on the roller coaster.
Yeah, exactly.
No, absolutely. And I think that is usually the hardest lesson for an entrepreneur to for an
Yeah,
investor to learn, right? That
right,
you have no control, you have no sort of you can't control that ride at all.
right. Yeah. And again, that adds again a rationale to invest in a group of people. So as a group of people, as a group angel group or a fund, that gives you that diversification where you're investing in a larger number of companies
Right.
with the hope that, again, you're not going to get a 10x on your investment. You're going to get maybe a 2 or 3x because of the diversification. But that's what happens. Yeah.
Right. And with a fund, I think the other benefit is that, in a series A, or maybe not A, but maybe B or C, you have enough clout to say, okay, we'll sell our shares, and maybe you can get an earlier exit. That way you're
Right.
not necessarily waiting for the IPO
Yeah.
or the M&A event.
Yeah. And that makes sense. I mean, if you can go from a Series A to a Series B and you say quadrupled your money or something, or even a
Right.
2x or 3x, and you exit, that's okay. Or exit part of it. Sell
Right.
half your stake or something, and then at least you return investors' money.
Yep, exactly. At least you return the principal, and now you have the
Right.
equity to sort of ride that profit.
Right.
Very interesting. So obviously there's a lot going on in the world this year, 2020. And obviously with the pandemic going on, there are some companies that have benefited, some haven't. So what has your experience been like this year? Because this year it's like all rules are thrown out the window. We're starting
Right.
over. So
In some ways, whenever there's a crisis like this, I mean, this crisis is different compared to many other events. But whenever there's a downturn in the economy or some particular industry sector is getting hit for whatever reason, lots of the fluff in the industry goes away.
mm,
In fact, when we were running our business guidance back in the software, when the dotcom glory days, I mean, I hate to say it, but we had 200 people, but not all 200 were at the top of their game because we
right,
couldn't find good people. And so we just have to hire kind of the second tier candidates
right.
because we just couldn't find anyone else. So as a result, when there's a difficult time, those are the people you cut back on first, the people who kind of are your second tier, and you try to keep your best people. So in
Mm,
that sense, just like that, in a crisis, say in the COVID situation, some of the companies that are stronger will survive. So
mm,
companies that were more fluff and lots of just talk, they will just die. So
mm,
essentially, the companies that are left over are the ones that maybe they're still struggling because of the economy, but they're the ones that were stronger to start with, and also they're the ones that are going to survive later on. So essentially, you've gotten a natural filter.
fantastic. That's such a great way to look at it, that this is, we can benefit from this. And maybe benefit
Right.
is too too big of a word, but at least we can see, we can, as you said, we can cut out the fluff, and we can focus on the
Right.
on companies and people that are really adding value.
And also, it's a possibility that because of the situation, the valuation you might get might be a little bit better.
Mm,
Um, but I mean, it also means that the company is also going to struggle a little bit. Whatever projections they had for 2020 might go down to maybe a year or two from now.
right.
And the economy is struggling, so the amount of sales or profit is going to be lower as well. So in that sense, that kind of is the rationale for a lower valuation. But again, you've got a better chance of success, assuming that the retraction or the whatever happened is temporary. It's not going to last forever.
Right. So let's talk about valuation a little bit more, because I think that's a really interesting challenge that a lot of people are struggling with right now. Some companies' valuations have cratered because the demand has disappeared. They're not able to close the contracts that they had. But on the other hand, some companies have sort of skyrocketed. If you had telehealth anywhere in your business plan,
Right.
you're sort of, you can charge 10x now because that industry is booming. So beyond just actually looking at the numbers and seeing how much revenue a company has, or how much traction they're able to get, do you give that kind of a benefit to any particular company just because of the market environment?
The valuation of, especially in the startup environment, has nothing to do with the numbers. I mean, yeah, a founder might say that my next year revenue is going to be so much, I want a 10x multiple on that. But it's completely dependent on what someone's willing to invest at. It's a matter of supply and demand. Suppose a company says I'm worth 20 million and they can only raise money at a 5 million value. That's the value of the company, 5 million. Right. It's not 20. It doesn't matter what the person says it is. At the same time, the company might only be worth 1, but people are saying, I'm willing to invest at 5. So it's really a supply and demand situation. Mm-hmm. And if you get one investor to jump up to a certain valuation, others will kind of follow. So suppose a company is raising, say, 3 million, and one person or one group commits to 1 million at a certain value, then it's like everybody else is just going to tag along. And the justification for that valuation might be completely different for that particular individual. They might have a strategic fit for some reason. It might be, they might be looking at buying that company later on. So the rationale for a certain valuation is so personal, and there's a supply and demand situation. So it's a matter of how much money you're going to invest. If you're going to take a significant share, then you can drive that valuation. But most of us at the angel investing level, we're not taking a significant share in the company, so we just have to tag along. And either we're comfortable or not comfortable. That's kind of the decision. We're not going to be able to change the terms.
Right. That's such an important lesson for the entrepreneur also, because they come in with something in their mind and they're like, well, I'm a telehealth. Of course I can charge 10 million.
Right, exactly, yeah.
And they also have to recognize that, okay, well, there might be 20 other companies that are also pitching the same business plan. So your valuation naturally goes
also
down.
The technology, or what's the technology, or the whatever's the buzzword of the year, that changes every year.
Right.
So this is telehealth. Next year it could be something else. It could be space or something, right?
Right.
I mean, there were years when the mobile was like the hottest thing. Social media was the hottest thing.
Right.
Now, you say you're a mobile or social media company, you're like, what?
Why?
Right. So that's another thing. You should try not to get sucked in by the buzz of the year.
Right. And and you also, if you're an entrepreneur and you're starting with something like that in mind, then you're already way behind the 8 ball. Because if you're starting a telehealth today, that by the time you're ready for funding, we might have moved on to some other buzzword. So
it's almost like these companies have to hit that right junction, kind of the right place, right time. Mm-hmm. At the right time. These telehealth companies might have been working on this for the last 5 years, but now it just happened.
Exactly.
And everyone calls themselves AI, ML companies nowadays, but that's, again, it's something they were always doing. They're just calling that right now, with the hope that that's going to lead to some investment change or something.
Right. To me, the AI ML thing is sort of the 5 years ago. If you started your company 5 years ago, you automatically wanted to include the word AI in there, because that was the buzzword back then. And now you're just trying to sort of milk it for that functionality.
And even then, there was nothing really AI or ML about anything. That's what they were doing anyway. and
Right.
they're just calling it AI now. But
Right.
what really has changed is there are more tools to support that kind of. For example, suppose you wanted to add a speech recognition chat box into your software. You don't need to build it anymore; it's there.
It's right.
So, in that sense, many of those technologies, many of those buzzwords have led to certain modularized technologies that can just be adopted, with which would have taken a lot of work to have done before. And now
Right.
it's much easier. So if you want to do some sort of vision app or integrate video, integrate chat, that's super easy now.
Right. That a lot of these building blocks are now available. So now it's
Right.
plug and play. So you
Right.
really can't build a company just based on that
Hmm.
one functionality. Now
Exactly.
it's
Yeah.
like, what are you doing with that functionality? That's the question.
Right. Absolutely.
Fantastic. So this has been such a great interview, and
Mhm. Yeah.
I could probably talk to you for days about this
Sure.
stuff, about angel investing. But I want to end with sort of the standard question, the action step
Mhm.
question that I ask every investor. What can the entrepreneur do today to increase their chances of getting an investment from you? What do you look for in startups, in companies?
Um, my question usually when I'm trying to invest is why should I not invest first?
Mm,
And if all those things can be addressed in some way, then I've moved to the thing of why I should invest. Rather than my, say, 5 years ago, I'd find every reason to invest in a company and not the reasons not to invest.
right.
And that kind of gives you a better filter. So in my mind, it's what would it take to build that product or that service now? So suppose a company has built, say, some software or something. They've spent 5 years doing it, and yeah, they made some mistakes, but they've got to a certain point, and it's working now. What would it take to build something like that? If I had to raise some money and build that myself, what would it take for me to get to where they are? And if it's something that a company can, if they come and tell me that, hey, it took us 5 years and $3 million to build, but it, but now that we've done it, someone could build it with 500,000. Then it's
Right.
not because I could do it, right?
Right.
So it's really what's different about them. What kind of moat have they built? What kind of technology advance they have compared to anyone else? If they can look at those things, that's basically a turn on for me. And then of course, the founders and all that have to sync up. But if they really have something that they're leaps and bounds ahead of someone else, and it's going to take someone a lot of money and a lot of time to duplicate, then that's worth investing into.
Right. That's so good. That focusing on why not to invest and why, like,
Yeah.
what you can, how easily you can replicate their product, I think is such a key thing that
Yeah.
a lot of entrepreneurs don't even think about.
Mhm.
Right. Eh, eh,
Mhm.
so I love that. That's fantastic. So Vijay, thank you so much for coming
Sure.
on today
My
and
pleasure.
sharing all of your lessons with us. Any last
Awesome.
words?
No, great. Love what you guys are doing. Good luck with this, and love to see your other interviews and your other companies that you're working with.
Absolutely, absolutely. I'll definitely keep you posted. And in any way, we talk at least 3 to 4 times a week anyway. So
All right.
we'll definitely be in touch, and I'll keep you posted on the progress. Thank you.
All right. Take care. Bye bye.
That was a fantastic interview. Again, I want to thank Vijay for coming on today and doing the interview with us and sharing his experience and his knowledge. And there's a ton to learn from him. Having said that, if you enjoyed the interview and if you enjoy content like this, make sure you click the subscribe button. So this way you get our content as soon as it comes out. Um, if you're an investor, once again, if you're looking to learn how to be an investor or are an angel investor already and are looking to get resources, get connected to companies in our system, make sure you send us an email. My email address is on screen. It's also in the description below. Send us your contact information and we'll be in touch. We'll get you added to our platform and hopefully help you start becoming a better investor. if you are an entrepreneur and and are looking to raise capital for your startup, go to startupsteroid.com and click on the founder button there. Fill out the form, and this way we can get you added to our database and start sharing your information with our network. Thank you again for joining us today. Make sure you hit subscribe, and we'll see you next time. Bye.